Let's bring in Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, great to see you on the program today. Thank you so much for joining us. Let's talk about the oil price there. I mean, there's a lot of optimism, it seems now, that OPEC will in fact extend those production cuts. How likely do you think that is, and do we need that? Does the market need to see an extension to those production cuts?
No, I don't think we do, but I do think the oil market is just consolidating into a very narrow but volatile trading range. I think the market continues to look at headlines and less at fundamentals. If it was just driven by fundamentals, then oil would probably remain in the low 50s from now until the end of the year. But I think there's going to be a lot of puts and takes given the talks from OPEC and non-OPEC entities alike.
We know the work that OPEC has been doing to try and curb the excess supply that we've got in the market. It seems like the US shale market, though, is really the problem, because once we see the price moving upwards, the US shale guys kind of ramp things up even more, adding that supply back into the market. OPEC now seeming to urge those US shale producers to actually assist in keeping a cap on that global supply.
Yeah, it's very interesting to see how this will all play out. And when you look at the spread right now between Brent and WTI, it does give exporters in the United States a lot of incentive to start moving oil and producing it, refining it, and moving it offshore. So I'm sure that has a lot to do with it. And right now, especially you look out, and the January spread is out around $6. It seems like too wide to be true, but there must be a reason for it. But I do believe that has a lot to do with the oil production here in the U.S. is that spread differential and that deep incentive right now to export oil.
Of course, the dollar. I mean, this played such a large part as well, doesn't it, in the moves for the oil price. We've been seeing that US dollar slowly making a recovery, so the strength of that dollar kind of putting that downward pressure on commodities. What is your view on where you see the US dollar moving?
Well, I still think the dollar is overpriced. I see the trade weighted like U.S. dollar up about $2.50 since the end of August, and I think with the uncertainties of tapering and the uncertainties of interest rate differentials between countries, not to mention politics, I do believe the U.S. dollar has overshot itself, and it is due for a retracement anytime soon.
Now, iron ore, we know that iron ore has kind of been unwinding as well. It's given back a fair big chunk of the gains that we did see. And again, overnight, it was lower. I mean, it seems to be tracking what's happening in the steel markets, capacity cuts with steel production and so forth. What's your view on where you see the iron ore price going?
Yeah, I'm constructive on the price. I mean, I do think in U.S. terms, I'm on the high end of the range of $70 by the end of the year. And I think between now and then, it's really about the momentum of the numbers coming out of China. I mean, I try not to read the headlines. I almost read the newspaper, one that's a week old, so I don't get caught up in the very latest news to disturb my trading decision. But I'm constructive on the price, and I do think when you have like so much of the capacity shut down, you basically have 2 or 3 producers that can dictate price. So right now, when anybody can dictate price, that means we're going to go back up.
Now, if we look at some of those precious metals, we were watching the dollar slightly weaker in the overnight session. Yes, we talk about that recovery, but overnight slightly weaker, and precious metals have been strong, talking of gold. So not just the weakness of the currency, but heightened geopolitical tensions, as we know. It seems like gold is really trading on geopolitical tensions as opposed to the interest rate hike debate. I mean, how long do you think that will continue?
Yeah. Well, that's a great question. I mean, you consider the fact that gold is still like $40 to $50 lower than it was in the beginning of September. I tend to think that it's not so much the absolute interest rate that dictates the price. I do think it's more the momentum or the direction and also the confidence that people have in central banks. And so when there's lack of confidence, gold prices go up and vice versa. And I think when we had all those unknowns with zero rate interest policies and quantitative easing, that took gold up to $1,800 an ounce. But now that we're starting to taper, yeah, I do believe the short moves are interest rate related. That is true. But I think it's more about confidence of how this will all end up. And we have to remember that this is a policy experiment that's never been tried before. So it doesn't surprise me to see gold as volatile as it is, although I do believe that it will be lower at the end of the year.
Let's talk about the moves on the market more broadly. Yes, those energy stocks have been supportive there today, along with Walmart. These record highs just keep continuing for the US market. What are you making of the levels we're at right now?
Yeah, like with energy, I still think like the valuations of the big energy stocks are cheap relative to the market. They're not cheap, but relative to the rest of the market, especially when you consider capital expenditure cuts that have been taking place, and I think their house is in order. So I'm very bullish on the oil sector as a whole. When it comes to Walmart, anything that comes out with regards to competing with Amazon or really trying to take them on, that's probably good for the stock and for the consumer sector in general.
Now, looking ahead, we have the Fed minutes, so I don't think there's any expectation we'll see anything sort of new out of that. We're also looking ahead to corporate earnings, hoping to see that earnings momentum justifying these record highs that we have been seeing on the market. Do you think there is an expectation that corporate earnings will continue to point to solid growth?
Yeah, I think I beg to differ a little bit with the consensus, but I do think the third quarter is going to surprise people. First of all, expectations are much, much lower than they have been in the past. Consider that commodity prices were stable in the third quarter. Think of all the economic data, the ISM reports, the PMIs, especially Eurozone PMI at 56.7, industrial production, factory, etc. It's all been very good. We're in the midst of a synchronized global recovery, and I think the third quarter is going to show that, headwinds and all. So I think it's going to be good, and I think, if anything, stocks are relatively cheap compared to bonds, and that's what people have to look at. Are they expensive? Absolutely, yes. But relative to everything else, they seem to be a good bargain.
All right, fantastic. Larry, we'll leave it there. Pleasure talking as always. Thank you so much.